read through these worries. None of them are the Fed, Mark. Even less so based on the FOMC minutes yesterday?
Yes, I think the Fed is, you can blame it or place the reasoning where you like, but the Fed has done a 180-degree about face. They're stopping raising interest rates. I frankly don't think there are going to be any more interest rates the rest of the year. I think it's marvelous, and I mean marvelous, for the markets because the Fed is, short of a war, has the biggest influence on both the equity and the debt markets. I think their decision, by the way, was correct. I've been calling for it for a long time. There are people certainly at the Fed that get what I write every day. Maybe they listen to President Trump. However they arrived at it, I think it was absolutely the correct decision.
Are you worried that if the markets rally a lot, that the Fed will be back in play with a rate hike?
No, I don't see them shifting like that. They don't have that kind of mentality. Interestingly enough, I just did some homework on inflation, which the St. Louis Fed president was talking about. Tips for the year are the American inflation rate is down in the red, about 0.9%. But if you look across the world, Europe, every place else, Japan, there are no inflation any place, at least according to the market indicators.
So, James, I have to bring you back in because before you had said that the Fed was paying attention to market signals toward the end of last year. What is the market signal should the market rally very strongly? I mean, we've already seen a bounce back rally, but rally further. Is that market signal that the Fed should become hawkish again?
Well,
sorry, I'm talking to James.
We don't want to react directly to markets because markets go up and down, but to the extent markets saw future growth being stronger or future inflation being stronger, that might be a signal that we could take. And when I'm talking about market signals, I like to talk about the tips market and inflation compensation, and I also like to talk about the yield curve, because I think the yield curve has been downplayed historically by the Fed, but this time around I think it's getting more attention, and I think it should get more attention.
Mark, your biggest worry is, number one, that the Democrats will try to impeach the president, which would, you think, say, be a travesty. The next is the economy in China and not the trade war. So you're worried about some sort of contagion or ripple effect around the world because of a slowdown in China, even though the Chinese could potentially cut rates. I mean, they cut rates the last slowdown, what, 6 times between 2014 and 2015.
I think the biggest worries in the world would be somebody, you know, the Democrats trying to impeach Trump, which I think would put the country and the markets in chaos. Second, my focus is much more on the economy in China than the trade wars with the United States. I think the real economy in China is up someplace around 2 to 2.5%. But I think that their amount of debt that they've amassed in the last 3 years in both their normal banking system and the shadow banking system is onerous and is going to cause giant problems. And of course, China's economy has big effects globally.